Good evening, everyone. This is Wayne, and this is the video version of the trade report for Tuesday, May 22nd, 2018. Well, the markets kind of meandered most of the day, and then finally, with a little bit of help from POTUS, made a decision. And that decision was, stay tuned to find out more. Greetings, everyone, and thank you once again for spending part of your day with me as I go over the action and activity in the financial markets from today. Okay, well, not mincing my words, but it was a boring day today until it wasn't. And I got to thank President Trump for opening his mouth and making something happen. We tried to go higher and failed and tried again and failed and then decided that it really wasn't even worth committing to a direction of any sort and went sideways for about 2 hours. Then Trump decided it's time to tell everyone that he's just not happy with what's going on in China as far as the trade talks are concerned. That got the market moving, and boy did it move. Nice push to the downside. Lost about 12, 13 points in a matter of an hour and a half or so. Pretty decent push to the downside. We didn't get a lot of reaction out of the VIX, the volatility index, but yeah, at least this provided an opportunity to go long. Now, there's a lot behind that comment I just made. When the market moves down in a radical fashion on the words of President Trump, we have come to learn that it's a temporary condition. Now, the nature of those words in this particular situation are important. We had Treasury Secretary Mnuchin coming out over the weekend and saying things are going well in China as far as trade talks. And the market gapped open on Sunday, and that gap was held in the market yesterday. We closed higher. Looked like we might get higher than the March 14th highs and break out to the upside. Well, here we are again, back down into mediocrity. So we're down, but again, in my opinion, that provides a buying opportunity. We're not doing anything but going back and forth, folks. If it ain't one thing, it's another. I think that was Rosanna Dana from the 70s Saturday Night Live. And anyway, for those of you who don't know who I'm talking about, do a Google search. You'll see. But she was always coming out saying, if it ain't one thing, it's another. If it's not this, then it's that. And that's exactly what this news cycle has been about for the last year and a half. So we get a push down. Tomorrow, we'll probably do something like that. And the bigger picture is basically sideways action at this point. It really looked like we might get a move to the upside that would push us past that point where the markets could begin making some definitive movements to the upside. Now, what I want to do is get a chart of the S&P cash, and that's what this chart is here. And here is that 618 right here. The 618 is the level, the Fibonacci level that we hit back on March 14th. Like I said, we had a high of 2742.10 on the S&P. Today, we had a high of 2742.24, and we backed off hard. So we've got a market that appears to be stuck in this range right here. We are moving in this sideways bias, back and forth, up and down, approximately 30 to 35 point range that can't seem to get resolved. Today it looked like we might pop higher. Not gonna happen. And so here we are again. And now we have a bearish candlestick pattern that if it's confirmed tomorrow, means we're going to head lower again. This is called a bearish engulfing. This is where the body of this candle basically engulfs or consumes, if you will, the body of the previous day's candle. And that's what we have. So we have a bearish chart pattern now on the S&P 500. It is what it is. We take it with a grain of salt. We look at it and understand that this is the nature of the market conditions that we find ourselves in. We've got a market that has been super choppy and has given us more action than we've seen in an enormous period of time. But we also see a market that looks like it wanted to break out, but is now, as I mentioned, just kind of meandering about. So how do we treat this? Well, always remain hedged. Always in a market such as this one, in my opinion, it's vital that we remain protected. We just don't know if the market's going to do something like this. We really don't. It can't go higher, apparently, or for whatever reason doesn't want to. Can't get the oomph it needs of its own accord or extrapolated from any of the surrounding circumstances associated with it to go higher. So it sits here and goes sideways and basically presents itself as being victimized by everything around it. We are, for all intents and purposes, outside of earnings season. There's nothing else for this market to really trade off of at this point. We need something that is going to either inspire or totally de-inspire this market. We either need another push to the downside, or we need something to bring us back to life. Other than that, we're just going to sit here and play this game for the foreseeable future. And this is how I am speaking is through the context of frustration. And that's not to say that there aren't any opportunities in the market, but it basically is a market that can't make up its mind, a market that is constantly under the influence of the circumstances and situations outside of it and willing to allow itself to be ruled by those circumstances, is a market that is finding itself embroiled in uncertainty. And uncertainty is the condition the market not only detests the most, but cannot get any traction to provide anything definitive for market participants. So we have to be extremely judicious. We have to be very careful in the positions that we take, because at the whim of the president or another world leader, our markets can fly high or simply die. It's really an odd environment that we're currently finding ourselves. But we do have opportunities. And there are certain trading strategies associated with the way the market is currently moving that gives us those strategies, gives us those high probability trading opportunities through those strategies. And these particular types of trading strategies, methodologies, if you will, are known as butterfly trades. They're very low investment. And if you know how to trade them correctly, you can set them up in your portfolio in a way, hedged, that provide you with good quality portfolio holdings that are perfect for this kind of environment, this back and forth. So I'm not going to go into what makes up a butterfly trade, but if you do look back at my RUT, RUT is the ticker symbol, which is the Russell 2000 cash market, RUT bearish butterfly trading strategy video from, I think it was last week. If you watch that video, you'll see the trading strategy, and that trade is actually starting to come through now. And that's primarily because the rut has begun to move lower, which is part of what I've been talking about over the last couple of trading sessions. So here's the Russell. Now, I mentioned yesterday in the trade report that we were overextended from a symmetry perspective, which is basically looking at how this market has gone up and then gone down, and looked at how many days the market has actually gone up in the rut before it's gone down. And I think this was like 8 days, this was like 11 days, this was 12 days, and this was 14 days. So we were a little overextended. Well, guess what? Today we went lower. Now, I'd like to see it go a little bit lower to benefit my trade, but this is the kind of thing for demonstration purposes, if you will, that happens. You get movements in accordance with market symmetry. And I would expect potentially we get another few days down based on downside symmetry. So we've got 3 days here, we got a lot of days here. We've got about 6-7 days here. Got a lot of days here too, but these moves here, I mean, this was the January high to the February low, so that it's a little extreme. But you get this kind of action, you get this kind of action. But you could have one of these. You could have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. You could have 12 days down with a couple of up moves in between. But for the most part, you can see where this is a downtrend that terminated there. So what will this look like? Well, only time will tell. But we are in a sideways market. We're not in a downtrend anymore like we were back here. So to expect the market to move like this may be a little bit inaccurate. I would say maybe more like this. And probably not even like this. Probably more like this. 2 or 3 days down. Maybe. The rut is very bullish. So we'll have to see. But we're starting to get that down move. So all things being equal, the market is responding in a way that I was looking for. It took a little longer than I expected it to, but we are getting that pullback off of this rather parabolic up move. And we'll just have to see how long it lasts. We do have some resistance turn support down here at 1609, which would be just about right for my bearish butterflies. And we'll see if it comes to play or comes to pass. At any rate, we've got a market that is, kind of dilly-dallying around, not necessarily committing itself to anything, and just waiting for the next shoe to drop for all intents and purposes. All right, so now I'm going to show you the VIX, because we always look at the VIX. The VIX went up just a little bit today, and that was primarily because right at the end of the day, the market went lower. But you can see there's really no commitment here. This down move is still very much intact. But this could be the move up that I've been looking for, possibly to move through this area right here. I don't know. I'm going to continue to talk about this and show you what I'm talking about as it relates to this as time goes on. But for all intents and purposes, we've got a market that just really isn't going to give us anything definitive that we can trade on. Now, the bearish butterfly trade that I have on in the rut is working finally. It expires at the end of this week, so I've only got 3 more days. We'll see if it plays out, may or may not. You can see in the extended session here, and then we have about 30 seconds left before quiet time. But you can see how the S&P futures are falling a little bit. We've got the Russell futures falling ever so slightly, the Dow futures ever so slightly, and the NASDAQ ever so slightly. So the markets are pulling back a little bit, and we'll get quiet time in about 10 seconds here, and then no more movement for a while. The last chart I want to show you is crude oil. I had a trade in crude oil. I was bearish crude oil, and I had to exit my trade. And I'll show you why I did that. as soon as I can get my chart up here. There it goes. I've got a little bit of a delay in my platform here. That could be for any number of reasons, but I do have a lot of windows on my computer open. So, okay. So crude popped up above this trend line, and I would expect a pullback when it does that. Well, it went even higher today. When it does that, and it does it on a 15-minute chart with a buy signal, which is exactly what happened in crude oil today. According to my trading plan, I've got to exit that trade, which I did. But it was only a $30 loser. But you can see it did move in my direction. Now, if it continues moving in my direction, I will evaluate, reevaluate, and make a determination as to whether or not I want to re-enter the trade. But I have to formulate an entirely new thesis as it relates to that. Entering a trade and exiting a trade based on a thesis is a full spectrum entry, exit, done with it. The next trade that you enter is not a continuation of that first trade. You must formulate an entirely new trade thesis as it relates to the underlying, in this case, crude oil. And the trap that a lot of traders get stuck in is, oh, it's doing what I thought it would do, I'm going to get back in. And that's not necessarily a bad or wrong thing, but it confuses the trader's psyche. Because what happens typically is they don't look at the second trade as being a separate trade. They look at the second trade as being a continuation of the first trade, and you aren't able to separate your trade thesis from the first trade, from the second trade, and there's some subsequent confusion that takes place. Now, if the trade goes in your direction, it's all fine and good, but oftentimes the underlying moves differently than when you would have gotten in the first time, or when you did get in the first time. So anyway, I'm getting a little bit off track here, but suffice it to say that separating your trades and your trade theses is how you maintain a balanced trader psyche so that you can explore the trade and trade cycles of your trades in a more productive and objective manner, and subsequently become more profitable. So with that, I wish you trade safe, trade what you see if you choose to trade at all. Good night and good trading.